Welcome to the analysis of Bharat Forge Q1 results for the financial year 2027. This video explains the company's quarterly performance and why its share price fell. The results were announced on the 10th of August 2026. Let us start with the results overview. Bharat Forge showed mixed performance this quarter. Revenue was strong and grew by almost 19%, reaching 4,640 crore rupees. However, the company reported a net loss of 90 crore rupees because of big one-time expenses. The operating profit margin also fell. Standalone profit from the main Indian business dropped slightly by 5%. Most of the loss came from 358 crore rupees of exceptional items related to restructuring in Germany. Now looking at the key financial numbers in detail. Revenue jumped 18.7% to 4,640 crore. EBITDA, which is operating profit, grew only about 5% to 709 crore. The EBITDA margin dropped 170 basis points to 15.3%. The company posted a net loss of 90 crore instead of the 284 crore profit it made last year. On a standalone basis, which is the core Indian operations, profit was 321 crore, down 5%. Why did the company report a net loss? The main reason is 358 crore rupees of exceptional items. These were mostly one-time costs for restructuring the German subsidiary called Bharat Forge CDP GmbH. The European business is facing market challenges, so the company took provisions and voluntary retirement scheme costs. The good news is that management says no more big exceptional charges are expected in this financial year. The European restructuring should be completed by the middle of financial year 2028. Why did the profit margins come under pressure? There were higher energy and raw material costs this quarter. The conflict in West Asia increased energy prices. There were also LPG shortages, forcing the company to switch to other fuels which cost more. In the United States, some forging presses broke down temporarily and affected production. Management expects to recover these extra costs from customers in the coming months. Now, why did the stock price fall 7 to 9% on the day of results? Investors were disappointed because the company reported a loss instead of the profit that was expected. Operating profit and net profit both missed the estimates of analysts. Margins also came down. The board approved raising up to 2,500 crore rupees, which created some worry about share dilution. Management also sounded cautious about medium-term profitability, especially for the overseas businesses. Despite the loss, there are several positive points. Revenue growth of almost 19% is healthy. The defense business is doing very well with new orders and a large order book. Exports have started recovering after a weak period. The main Indian standalone business continues to be resilient. The company is also diversifying into new areas like aerospace and data center components, which can support future growth. Let us hear what management is saying about the future. Chairman and Managing Director Baba Kalyani guided that the Indian manufacturing business should grow 20 to 25% in the full financial year 2027. Margins are expected to recover to 27 to 28% already in the second quarter. The second half of the year should be even stronger. The company is investing around 1,800 crore rupees in high-technology areas. India is becoming the main manufacturing base for global customers because of cost advantage. Looking at the growth drivers ahead, the new aerospace facility is expected to be ready by December 2026 or January 2027. Data center-related components will start operations by early 2027. Defense production of artillery guns and small arms is set to ramp up. The company is expanding capacity in several sunrise sectors. Overall, management expects a much stronger second half of the financial year. To summarize everything simply, the core operations of Bharat Forge are healthy. Revenue and the defense business are strong. The net loss was mainly because of one-time restructuring costs in Germany. Near-term sentiment remains cautious until margins improve. The long-term story of diversification into new areas is still intact. Investors should watch the second quarter results carefully for confirmation of margin recovery. Important note: this video is only for information purposes. It is not investment advice. Please do your own research before making any investment decision.